What is up, guys? In today's video, I'm going to explain capital gains and how the taxation on capital gains works for individuals, not for corporations. That's completely separate, and I might make a video one day, but this is just for individuals. As well, I'm going to be talking about 4 different ways you can actually use to reduce your tax bill, so stick around till the end. But with that, let's get right into the video. Okay, so what is a capital gain and how does it work in Canada? Here's the basics of a capital gain. It's quite simple. All a capital gain is when you have some type of capital, go figure, and that could be stocks, that could be shares in a mutual fund, that could be real estate, that could be shares in an ETF, an exchange traded fund. And what happens is whenever there's an increase in value from what you bought it from. So I'm gonna give you 2 fancy acronyms here that we love to use in the taxation industry, I suppose you could call it. And that is the first one, ACB. What that means is adjusted cost base. All that means is what did you buy it for? The other one is FMV. That stands for fair market value. All that means, what did you sell it for? When you have an increase in value in some type of capital and you sell it, you will have a capital gain. You buy something for $100, such as a stock in Apple, and you sell it for $150, there is a capital gain. Now, how the taxes on that works, and by the way, if you actually look up capital gains tax, you probably won't find that much stuff because there's no such thing as capital gains tax. There's no tax on capital gains. How it works is right now in Canada, we have something known as a 50% inclusion rate. Now, you might hear people talking about this when they talk about changes to the budget or how are we gonna pay for things moving forward, and them talking about, the Department of Finance that is, talking about increasing this inclusion rate to maybe 75%, and I'll explain why that might be a bad thing. When you have an inclusion rate of 50%, that means that 50% of the capital gain will get added to your income. So if you bought a share in Apple, hypothetically for $100, and you sold it for $150, your capital gain would be $50, okay? 150 is the fair market value, 100 is the ACB, 150 minus 100 is $50. And you take 50% of that, because that's our inclusion rate right now, and you add that to your income for the year. So 50% of $50 would be $25. Now, you can see if we increase this to 75%, the taxes would go up as well because 75% of $50 is $37.50. So instead of $25 getting added to your income, you'd have $37.50 added to your income and you'd be paying more taxes. Now, there's 2 different kinds of capital gains, and you may have heard these different terms before in investment. There is what's known as realized capital gains, and all that means is that you actually sold it. You bought a share of something for $100 and you sold it that year for $150, you would have a realized capital gain of $50. An unrealized capital gain is where you're essentially now sitting on a potential capital gain. Because remember, a capital gain is only triggered when you sell something. So let's say that you have the same share in Apple, you bought it for $100, and a few years go by and you're holding on to that stock and you're not selling it, you're not paying any taxes so far, okay? Well, now it's worth $1,000. Well, now you have a $900 unrealized capital gain. And all that means is it's sitting there, it hasn't triggered yet, but at some point it will. So you want to be calculating how much unrealized capital gains you have to maybe potentially look at what tax bill you may have in the future. Now, maybe if I give you a quick example here of some actual numbers, it'll make a little bit more sense. And by the way, if you're not familiar with taxation in Canada, I made another video and I'll put it right there. It's a really good video, explains a lot of these things, tax brackets, tax rates, and if you're not familiar with that or you're a little bit uncomfortable with it, watch that video, you'll learn a lot. But here's a quick example. So I'm just gonna read off my computer here, it might be a little bit easier. So if we have an Alberta resident, because we understand we have federal and provincial taxes, he's earning, let's say $80,000 a year as a salary, so his marginal tax rate is gonna be 30.5%, meaning that the next dollar he makes after that will be taxed at that 30.5%. Current taxes paid in that year will be $17,543. Let's say that this individual has stock in Apple. I seem to love Apple for some reason, I'm not sure why. He bought this stock at $5,000 and he sells it in this current year at $15,000. We're gonna have a capital gain of $10,000. 15,000 minus 5,000 equals $10,000. Now remember, we have that 50% inclusion right now. Hopefully it doesn't go up to 75. 50% of 10,000 is now what's gonna be added to our income. So that's $5,000. He originally was at $80,000 of salary, and now $5,000 gets added to that. So when he calculates his taxes for the year, he needs to declare that he made $85,000. The total taxes paid now after he added this capital gains to his income is going to be $19,068. That's an extra amount of taxes of $1,525. That's exactly 30.5% because that's our marginal tax rate. So that's how the taxes work on a capital gain. By the way, before I go on, I wanted to quickly tell you guys about Affinity Life. So Affinity Life is an online life insurance platform here in Canada. And so you have the ability to go onto this website and view quotes 100% online, as well as apply 100% online. So it's a completely digital life insurance platform. If that's something that might be interesting to you, I'll put the link in the description below and you can check that out. Okay, so let's talk about 4 different ways that you can actually reduce your tax bill on a capital gain in any given year. So if you have some potential tax bill or capital gain that's coming up, here's some ways that you can try and mitigate the taxes paid. The first way that you can reduce it is something known as a capital loss. Capital loss is very easy to understand. It's different from a capital gain. A capital gain is where you sell something above the ACB. And remember, the ACB is just a term we use to determine what you bought it for. What happens if you lost money, okay? What happens if you buy a stock in Apple at $1,000 and some reason it tanks, the iPhone didn't do as well, who knows? But it went down to $500 and you thought, I just wanna get out. I don't see a future in Apple. Let's just get out of this and get my money back, and you sell it for $500. Well, now what you have is essentially a $500 capital loss because 500 minus 1,000 is negative 500. Now this $500 capital loss can actually be used to offset your capital gain. So any capital loss you have can offset capital gains. It also, in some specific scenarios, can be used to offset your income for the year, okay? But it gets a little bit more complicated, so definitely have a chat with your accountant if you're looking into something like that. Now, if you have a capital loss, it can be carried back 3 years. So if you had a large capital gain, let's say 2 years ago, and then in this year you had a capital loss, you can actually carry it back to those second year, up to 3 years, and you can carry a capital loss forward indefinitely. So it's not lost, you didn't lose that money forever, don't worry. You can keep carrying it until you trigger some type of capital gain, and you can use it against that. One word of caution that I want to give just on capital losses is there's something that's known as superficial losses, and you have to be really careful about this. A superficial loss is where you sell something at a loss to use maybe to offset a capital gain, and then you immediately, let's say, buy it back in like 3 weeks. That will trigger something known as a superficial loss, and the CRA will disallow it and you will not be able to use that capital loss. What they're trying to prevent is you essentially declaring a capital loss. Maybe you had that $500 in Apple and you sell those shares in Apple at $500, and then you take that capital loss, and then a week later you immediately buy them back at, let's say, $505, okay? They want to prevent that. Another example of this would be, let's say, if you had some shares in an ETF and you sold those at a loss, and then you bought, let's say, a similar ETF in the same time frame, that will be considered a superficial loss as well. So just be very careful if that's something that you're trying to do, because the CRI will disallow that loss and you won't be able to use it. The second way that you can reduce your tax bill, and this is super simple that you can use, is just having good timing. Now, we know that our taxes are due April 30th every year. That means that if we sell in maybe December, we're gonna have a 2-month window before those taxes are due. But if we sell in January, then we have 14 months, essentially 15 months until the following year. If you have a large capital gain that you know you're going to trigger with some type of sale, maybe potentially time it in a way that just gives you more time to figure out how you're gonna deal with this capital gain. So if you sell it early in the year, you're gonna have more time before your taxes are due. If you sell it later in the year, you're gonna have much less time, and you'll just have less time to figure out how you're gonna deal with this tax bill. The third way that you can use to reduce your taxation on capital gains is using your RSP. And I made another video about RSPs, and I'll put it right there if you're curious. Contributing to your RSP can drastically reduce or eliminate altogether your potential tax bill that you have on a capital gain. So let's just use that quick example of $80,000 salary. And let's say they had a capital gain of, trying to make numbers easy here, $200,000. So we know that 100,000 of that, because of the 50%, is gonna get added to the income. Well, if you had the contribution room within your RRSP, you could take that 100,000 and put it into the RSP, and that would actually be used as a deduction against that current year's income. And it could potentially eliminate the entire tax bill that you had. One thing that I will note about this strategy is there's something called AMT, and what that stands for is alternative minimum tax. And it's kind of a complicated subject area. All it is essentially a mechanism by which the CRA says, hey, if you found a way to reduce your taxes almost to zero, we're gonna put a small minimum on that transaction just for their own purposes. I'm not sure why they do it, to be honest with you, but you do wanna be careful with that. It's a little bit complicated and outside the scope of this video. So if that's a strategy you're looking to do, it, make sure to talk to your financial advisors and to your accountant about possible AMT issues. The last strategy that I'm going to talk about is something known as capital gains reserve. There's some specific criteria and eligibility that you need to meet, and I'll put the link in the Canada.ca website and you can view everything in case you're curious, but this is generally how it works. Hypothetically, let's say that you sell some type of asset, maybe a vacation home. And let's say that you sell it to maybe another individual, or maybe you sell it to a family member, it doesn't matter. Let's say that they can't pay for it all at once, so they wanna spread out the payments over a number of years. Maybe you sell it for $400,000 and they say, I don't have all the money right now, I'll pay you $100,000 per year. What you can do is essentially spread out your capital gains over that 4-year period, and that's what's known as capital gains reserve. And that way, you're only getting a small tax bill in each year that they make a payment, and it's not a big lump sum tax bill all at once. So with that, I hope I answered all your questions about capital gains. If you guys have any more questions, put them in the comments below. And if you guys are enjoying this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next video.